Welcome back. So today we're kicking off something that's going to feel like a masterclass for anyone interested in the energy markets. Whether you're just getting started or you're aiming to be a pro in energy trading and risk management, we're going to start by decoding that price difference you always see between the two biggest names in crude oil, and, more importantly, how it creates a really unique trading opportunity.
You've probably seen this, right? You pull up a financial website, you look at commodities, and you see oil listed, but with two different prices. They're usually just a few bucks apart. And you've got to ask yourself, is that a typo? Is the data feed messing up? It's a question that honestly trips up a lot of people when they first dip their toes into energy.
Well, the answer is no. It is absolutely not an error. That price difference is very, very real, and it's what traders call a spread. And what's so important is that it represents one of the most classic, most fundamental trading strategies in the whole energy sector. Honestly, understanding this spread is step one to really getting the global flow of oil.
So, to get to the bottom of this, we need to properly introduce our two main characters. Think of this as a tale of two oils, Brent Crude and West Texas Intermediate, or as you'll pretty much always hear it called, WTI. And that price difference? It actually has a formal name, the Brent WTI Spread. It's just the gap between the price of Brent, which the whole world watches as the global benchmark, and WTI, which is the big one for the US market. Believe me, traders watch this number just as closely as they watch the price of oil itself.
Now, this is where it gets really interesting, because this slide boils it all down. WTI comes from sources deep inside the US, landlocked. That makes it a domestic benchmark. Brent, on the other hand, comes from the North Sea. It's seaborne, which means you can easily load it onto a tanker and ship it anywhere. That's why it's the global benchmark. This one geographical difference, it's the key to absolutely everything. And this table here really gets into the why. See, because WTI is landlocked, getting it from its main storage hub in Cushing, Oklahoma, out to the rest of the world means using pipelines. And pipelines can have bottlenecks, right? Well, Brent is already at sea. It's just way more accessible for the global market. And that accessibility, that's exactly why, for most of history, Brent has traded at a higher price, a premium, to WTI. The market is basically pricing in that extra flexibility. Okay, so we get what the spread is and why it exists. Now for the fun part. Let's get practical. If you have a belief, if you think this spread is about to get wider or tighter, how can you actually trade that? Well, you've got three main tools in your toolbox. All right, method one. This is the most direct and accessible route for a lot of retail traders. It's using CFDs or contracts for difference. Now, you're not actually buying barrels of oil, you're just trading the price movement. So if you think that price gap is going to shrink, you would buy WTI and sell Brent at the exact same time. But, and this is crucial, you have to be aware of the risks. CFDs use leverage, which is a double-edged sword. It magnifies your potential profits, but it also magnifies your potential losses.
Okay, let's move on to the professional's choice, futures contracts. Now this requires a more specialized broker, but it lets you trade the spread way more directly. And because these two contracts are super correlated, they're both oil after all, brokers give you what's called a margin offset. That makes it a really capital-efficient way for the big institutional traders to play the spread.
And finally, we have what you could call the regulated route, and that's using ETFs, or exchange-traded funds. This is pretty straightforward. You can buy shares in an ETF that tracks WTI, USO is a big one, and at the same time, you can short-sell shares in an ETF that tracks Brent, like BNO. For a lot of investors, this is probably the cleanest way to get exposure without having to worry about the leverage that comes with CFDs or futures. Theory is great, but let's make this real. Let's see how this all actually works with some real numbers. We're going to walk through a hypothetical trade where a trader is betting that the spread between Brent and WTI is about to get smaller. Okay, so here's our starting line. When our trade begins, let's say Brent is trading at $65.34 and WTI is down at $61.60. That difference, the spread, is $3.74 per barrel. Our trader looks at that and thinks, you know what? That gap is just too wide. It's gonna shrink. So to make that bet, the trader goes long WTI and short Brent. And as you can see right here in the table, their prediction plays out perfectly. WTI's price pops up to $63, which means they make a profit of $1.40 per barrel. Now, at the same time, look at Brent. Its price actually dips a little to 65 bucks. And because they were short, meaning they bet the price would fall, that move also makes them money, a profit of 34 cents a barrel. So, you add the profit from both sides of the trade, and on a standard contract size of 1,000 barrels, the total gain is $1,740. And this is just a perfect example of how a spread trader can make money by being right about the relative movement between two things, even if the whole oil market isn't going anywhere dramatic. Now that example looked pretty clean, right? Almost a little too easy. And that's why it's so important that we talk about the risks, because trading this spread is absolutely not a sure thing. So let's go over what you have to have on your radar. Think of this as your essential checklist. First, leverage. It is real, and it can wipe out an account very, very quickly if a trade moves against you. Second, that weekly EIA inventory report on Wednesdays, it can send WTI on a roller coaster. Third, OPEC decisions. Anytime they talk about production quotas, that has a massive impact on Brents. And finally, geopolitics. Anything from a conflict in the Middle East to sanctions on a country can just blow this spread wide open overnight. And that really brings us to this key takeaway, that historical relationship, where Brent is usually more expensive. That's not a law of physics. Major geopolitical events or huge shifts in U.S. production can cause the spread to widen like crazy, shrink to zero, or even invert, where WTI actually becomes more expensive than Brent. You have to be ready for anything. So the next time you see a headline, maybe it's about a pipeline problem in Texas, or a new oil discovery in the North Sea, or an OPEC meeting in Vienna, you'll now know the real question to ask. It's not just, what's this going to do to the price of oil? No, it's, what's this going to do to the spread? And that right there is the key. Thanks for tuning in.